If you take a look at the markets today, what a rally. I mean, investors are keen to conclude that the Fed is done, that inflation fight is over. It's too early, no?
Not quite yet. But it is true that the fight against inflation is starting to pay off. We have seen since last year the level of inflation globally dropping by half. We were over 11%, now we are slightly over 5%. And the trend is for this decline in inflation to continue, but not yet done. And I would repeat what we have been saying for quite some time. Be vigilant and data-driven. So I think part of the celebration comes not just from the inflation data, it comes from the fact that the world economy has been remarkably resilient. Labor markets continue to be tight. We expect growth this year to be in positive territory, although not as high as we would like to see it. And that on the background of the dramatic developments geopolitically, is a source for markets to say, hey, it could have been much worse.
Are you concerned about growth? When you take a look at developed markets, growth are pretty much below trend. Mm-hmm. Are we looking at a recession, perhaps?
We are not necessarily looking at recession. I think that we would retain this growth in positive territory, but it is weak. It is so pathetic to project growth at average 3% all the way to 2028, given that before the pandemic, the average was nearly 4%. So we are desperate for productivity growth. And one of the potential sources of productivity growth, everybody prays for it, is artificial intelligence, technological advancements, if they're properly done. So we have seen this last year some signs that maybe all the improvements in terms of shifting to digital economy during the pandemic may be starting to pay off. A little bit of a bright sign on the productivity front.
In terms of stimulus in China, is that also beginning to pay off? Also, we're seeing additional measures. Today, we had the PBOC injecting 600 billion yuan via the MLF. Finally, yes. I mean, are you encouraged by the moves, and what are you looking at in terms of its economy?
We are. We actually have just upgraded our projections for growth in China to 5.4% for this year. This is 0.4% upgrade. And also we are projecting higher growth for next year on the background of two things. One, policy measures, both on the fiscal side, some expectation for the deficit to go a little deeper, and on the side of People's Bank of China, very welcoming development. Nonetheless, when we discuss China, we need to remember that China's demography is changing, and if China is to sustain a reasonably high level of growth, it has to pursue structural reforms. More opening of the economy, more reforms of the state-owned enterprises, more attention to how the consumer can become the driver of growth in China rather than the export-led growth that we had in previous decades. And this is why we are recommending that China reforms the pension system, so people are not saving so much for old age. They don't spend enough to boost growth in the economy, and we are recommending a series of structural reforms. They can give China a growth boost in the years to come.
I'm just wondering how you see impact from the Israel-Hamas war, even if it doesn't translate to a regional war, even if it doesn't deepen. Surely that would have an impact if it persists next year.
What is so tragic is civilians dying in Israel, now civilians dying in Gaza. And that, of course, is the most painful consequence of a war. But there are also economic costs. For Gaza, the economy is devastated. West Bank, negatively impacted. Israel, negatively impacted. 8% of the labor force of Israel is now in the army. Then you look at the neighborhood, Lebanon, Jordan, Egypt. Tourism down, Investors are wary. We just completed a negotiation on staff-level agreement for Jordan, 1.2 billion. Jordan is quite resilient, but it is good to have this extra buffer. We also have a program for Egypt. And then we look at the world as a whole. And what we see is immediately oil prices jumped, then they calm down. But that jump is a reflection of anxiety. Look, we haven't yet recovered entirely from COVID. With the exception of the US, almost the whole world is below pre-pandemic trend. And on top of it comes war in Ukraine, cost of living crisis, now this war in Gaza. The world is on edge. Please, no more.
Might you have to revise down your projection, growth projection for the year, this year or next, if this war persists?
If it persists, but remains localized, the likely impact, this is what we know from history, on the rest of the world is likely to be minimal. But the longer it goes, the bigger is the risk of an accident. And an accident can have dramatic consequences. If there is an impact on oil prices, what we did in fighting inflation is going to be partially lost. So yes, that can be a big problem. More importantly, what we are seeing all over the world is the ugly head of anti-Semitism, of Islamophobia everywhere. So again, a war is terrible for those affected. A war is terrible for our anxious world as a whole.
Kristalina?
But no, we are not projecting, at this point, we are not projecting recession. However, look, we are in a world of exceptional uncertainty. Anything we can do to bring this uncertainty down is going to be healthy for the world economy.
You've always been concerned about surging debt. Currently, surging debt in emerging markets, I think something like 54, 55% from 40 before that, 10 years ago. I mean, could we be facing a full-blown debt crisis given this higher for longer environment?
What we need to recognize is that debt has gone up everywhere. We are now at 92% to GDP globally in terms of debt ratio. And that, of course, means that the longer we are not successful to bring inflation down, the higher the burden on the world economy. And that is why we are so supportive of central banks. Please get the job done. At the same time, we are not worried at the moment of a global debt crisis because, as I said, there is a remarkable resilience in the world economy. What we worry is the debt burden in low-income countries and a small number of vulnerable middle-income countries. And there, debt restructuring on case-by-case basis is a must. We have seen some progress with Chad, Zambia, Ghana, Sri Lanka, Suriname, now Malawi. And my plea is, let's get it done for the countries that need it, for them and also to reduce the fear of a debt crisis.
I want to bring in Pakistan. Negotiations are ongoing. How close are you to an agreement?
Close.
How close? What is key?
I expect an agreement of the review to come within this week. So any day now. And I can say that the Pakistani authorities, the Minister of Finance, they deserve credit for, in a very difficult time, sticking to the program that they have.
But what's key? What's the issue that's really stalling?
You know, in Pakistan, parental issue is tax collection. The country today collects 12% tax to GDP. We're saying it has to be at least 15% to have the revenues to sustain the functioning of your economy. So please, for the people in Pakistan that can pay taxes, collect it from them.